If you get this supply-demand dynamic take place in the equity market, Lisa mentioned the bid coming from people who just believe there will be no social security for them. There will be no pension available for them. They'll have to take care of this for themselves in years to come. Can you describe this constant bid, particularly this passive bid that we'll just see in the equity market, this tailwind for years to come?
Well, I think we're probably setting up to see it for years to come. But John, we got to be careful that we're coming on the heels of a very strong year-to-date equity market performance on the heels of last year's. So while I wouldn't say the equity markets are in a euphoric place, there's certainly a level of confidence out there that you need to be in the U.S. equity markets, okay? And you see this show up in the flows, and you've seen it particularly show up in the flows on the heels of the first Fed rate cut. We're talking about our ETF flow dynamics, and it's amazing the surge that's continued to go into core U.S. equity and growth equity exposures here. So there's no doubt that from a global investment perspective, U.S. equities, particularly S&P, are viewed as a very, very safe neighborhood to be moving into. So we expect that to continue, but we just have to keep in mind that we're being lulled into a security phase here, which has been warranted by fundamentals and by a peaking of Fed. And I'd go back to your earlier comments. When you're looking at coming off of a 2-year hawkish Fed narrative to something that starts out less restrictive, potentially moves a little bit down an easier path, that's hard to fight, right? So
yep.
we're expecting that the S&P can maintain a higher than traditional valuation setup, premised on much more resilient fundamentals than many would have thought going into this Fed hawkish narrative, a couple of years ago. And all told, what that does do, it does make large cap U.S. equities stand out as we think, a very good place for longer term investments.